All right, ladies and gentlemen, welcome back to the Market Insights Virtual Summit. This is Q2 2021. We're very happy to have you slowly flowing in, and I'm very excited because excited and sad because it's the last session for
Last
this
session for the
particular
day already.
summit. Alex, how are you feeling?
Happy that it is last session because I can finally take a break and have my meal. But sad is that, I think for the past 2 days, a lot of all these speakers are sharing their knowledge. I learned a lot from every one of them. So for example, Terence Tan, both Terence for today, Terence Tan from options and Terence Tan from the IG. Even for Rainer Teo, J-Tun, Binion, something that I also use from her wash and rinse strategy as well. You see, so every speaker is giving me some trade ideas and knowledge that I can build up and stack upon, you see.
Exactly. And I think that's all you and the team from MarketWise Asia deserve the full credit for assembling this, lineup of speakers that can actually really give a lot of variability and a lot of different strategies all together in 2 days. So I think you should give yourself a pat on the back,
Alex.
Alex.
I pat myself then. Oh, by the way, also just to share with you guys, it seems very easy that you guys just register for this event, and just listen to the audio. But for us, the back end, be it for Jeremiah, the MC, the speakers, for myself, we have to coordinate a lot of things. So it's not that easy. So I hope you guys can appreciate the sharing from all the speakers for the past 2 days. Okay, it is really not easy to assemble all the world-class speakers to speak to you guys. All right.
Yeah, and let's just give the team that have organized this and also all the speakers, thank them for such a beautiful kind of event so far. So maybe you guys can just put a TQ in the chat just to show a little bit of support for Alex, especially for the hard work that he and the team has put in.
Just on that, okay. By the way, I'm sure many of you guys you'll be asking whether the webinar will be recorded. The answer is still a yes if you are joining us. All right. So all the webinars will be recorded, and I will send the recording, the replays to you at the end of the session, maybe on tomorrow morning. Or tomorrow morning, I will send the link to you in your email. So if you're registered with us, you should be able to receive the replay links in your email. So do check your spam folders just in case the emails landed there. All right. Back to you, Jeremiah.
Alex, I think one of the questions was, can they get the slides from the presenter or no?
No, you won't be able to get the slide. Okay. Yeah. So but you'll be able to get the replay and everything.
Right.
So just review the video once again. All right.
Yeah, the replay will probably have the slides itself really. Okay.
Yeah.
Thank you so much, Alex, for the information. And with that, I'm just gonna do one last sharing, a couple of house announcements and a couple of information that I want you guys to be 100% in the loop on. So first of all, this is obviously our Market Insights Virtual Summit. This is for Q2. We have done yesterday a full day of live sessions. Today also we have done a full day of live sessions, and this is the last session that we are going to have. Once again, this is an event that's organized very proudly by MarketWise Asia, and a couple of media partners that we want to thank include BK Forex, Swim Trading, The Systematic Trader, as well as Terra Seeds. So they would have a couple of their sessions were covered by these sponsors or these media partners as well. So very nice to have them on board. And the next thing is that for all the information that we have and we constantly put out, it actually is all available on our Facebook and Telegram channels. Now, all you need to do is just click on the link that Alex will be sharing in the chat to join the group or follow the Telegram channel or group. And all of this is going to be very helpful, especially when we're constantly pushing out information about upcoming events, information about exclusive promotions, as well as some unique and special live streams that we host occasionally. Okay, so these things are all things that you definitely want to be kept in the loop on. So please go and join that small little community. Now, next up is an exclusive promotion that we're running with IG, who is one of our sponsors. So IG Asia is going to extend a free $100 credit whenever you open an account with IG. Of course, this needs to be a new account, and also you need to be having a Singapore residential address to be eligible for this. Alex has also sent the details in a link in the Zoom chat, and all you need to do is also just fund at least $500 into the account and execute at least one trade in 30 days. You will also stand to get one physical copy of the best-selling book, The Trader's Blueprint. So if you have not signed up for this, I highly encourage you to do so, because it's truly a really good kind of promotion that we are sharing right now. Now, the last thing I want to share is our upcoming event. So happening on the 10th and the 11th of July is our Market Insights Virtual Summit with the theme of trend following as a category that we will be sharing about. We have invited a lot of speakers, prestigious speakers and renowned speakers to speak at the event, and they include Tom Basso, who is the founder of Trendstat Capital Management, as well as Michael Koval, who is the best-selling author and also founder of trendfollowing.com. So that is going to be something I want you to keep your eyes peeled out for. One way to make sure you don't miss the event is to sign up for the event right now, which Alex has shared a link to. You can actually register for the event and just make sure that you secure your spot in this upcoming event once more. Okay, so that's what I wanted to share. And without further ado, let's move on to our very last session for the day. It's a bittersweet feeling because, you know, it is our last session, but at the same time, we have extracted so much value from the 2 days already. And this session is going to be led and given by Roger Montgomery. Now, Roger Montgomery is the founder, chairman, and chief investment officer of Montgomery Investment Management. And he is a renowned value investor with more than 25 years of experience. Now, following a successful career as an analyst and public company chairman, he actually published the first edition of his stock market guide, Value.able or Valuable, in 2010, and that became an Australian bestseller in just 16 weeks. Now, he's also consistently appearing in media outlets like ABC, 2GB Radio, and also writes regular commentary for major financial publications. Now, there's a lot more to Roger, but I already know and I already believe he's going to bring so much valuable insight and experience. Today, he will be talking about navigating infected markets and also answering the big question, are we actually in a bubble? So to guide us for this particular session, we have Roger. Roger, are you there with me?
Hi, guys. Great to be with you.
Thank you, Roger. First of all, Roger, thank you so much for joining us, and thank you for joining us over from Australia. I know it's evening time right now. We're probably disrupting your dinner a little bit, so I do highly appreciate you coming on. Before I hand the time over to you, I just wanted to let everyone know that I know you guys are going to have questions. When you do have any questions, if I could get you to ask your questions in the Q&A tab below. So on your Zoom screen, you would see at the bottom, there is a button called Q&A. Ask your questions in that tab instead of the general chat. That's where Roger will be picking up the questions to answer. And you don't want your questions to be missed out if they go to the general chat, okay? So that's one last thing I have. And with that, Roger, I'm gonna pass the time over to you. I'm really excited. Please take it away.
Thanks, Jeremiah. I'm gonna share my screen now and start the presentation. I'll talk for roughly 1 hour, and then we'll open up to Q&A, and I'll continue to answer your questions as they come in. I am a fund manager in Sydney, Australia. We manage about $1 billion or thereabouts. We also are responsible for distributing the Poland Capital Growth Fund in Australia, which Poland is based in Boca Raton in Florida, and they're very dear friends of ours. They manage about 60 billion US in a variety of growth portfolios. And what's impressive about them is the business was founded in 1979. Their flagship fund began in 1989. So for the last 30 odd years, they have generated a double-digit return. And I'm going to be sharing with you some of their insights, some of our insights, as well as giving you towards the end of the presentation a list of companies both in Australia and globally that we think have the potential to generate double-digit returns. Okay, with that, I am going to be mentioning, there's a short disclaimer here, guys. I just want to let you know you really do need to seek personal professional advice before doing anything in the securities market. I will be mentioning stocks that's not recommendation necessarily to buy. It's really important to understand that our thesis justifies the ownership of the stocks that I mentioned, but that thesis could change tomorrow. New information could come to light. And because I'm not keeping this forum open, it's going to end in about an hour and a half or thereabouts. The reality is that we could change our view, and I might not inform you of that. So it really is important that you do your own homework and seek personal professional advice. Okay, Montgomery, we have an Australian all-cap fund called the Montgomery Fund, as well as the Montgomery Private Fund. We also have a small companies fund called the Montgomery Small Companies Fund. And as I said earlier, we distribute a global equity product called the the Poland Capital Global Growth Fund. All of those products are available in Australia, and I think the Poland Capital Growth Fund is also available or distributed by somebody else in Singapore as well. So you can look that up. There's a UCITS product available for you. This is our team. Been working with many of them for many, many years, and absolutely delighted that I've assembled such a terrific team of people. Okay, in terms of our agenda today, we're going to be talking a little bit about the performance of our philosophy. I'm going to describe what our philosophy is. Then I'm going to address the question of whether or not we're in a bubble. Since the beginning of this year, and since Jeremy Grantham, on behalf of GMO, published his missive about the market being in the most stupendous bubble of all time, I thought it wise to actually address the questions that were raised by that particular document, which was released in January this year. And then once we answer that question, I'm then going to look at some of the themes that we think are useful or valuable investment themes for the next 12 months, 2 years and beyond. And then within those themes, I'm going to talk a little bit about some of the companies that we believe globally and in Australia represent either good value or great growth prospects. So the philosophy is a fairly straightforward one, and many of you might have a copy of the book I wrote some years ago called Valuable. And in that book, we talk about how to identify high quality business, how to identify businesses that are producing superior economics, how also to assess whether or not they have great prospects, and then how to calculate their intrinsic value. Now, there are a number of different ways of doing each of these things, and I'm not proposing that the book shows you all of the ways of identifying quality and all of the ways of calculating value, but it does it in a way that's been reliable and has worked over many, many years. So what is it that we're looking for? Well, in terms of premium quality economics, when we're looking for quality business, we're looking for businesses that can generate high rates of return on incremental capital. So what that means is that when you compare the profit to the equity in the business, we want to get a very high rate of return. It's a little bit like a bank account earning 1% or a bank account earning 20%. You'd much rather a bank account that's earning 20%. We would much rather own a business that has on its equity the ability to generate a 20, 30, 40% return on that equity. And then what we would like also is a business that generates that 20 or 30 or 40% return on equity, but then can retain a very large proportion of those profits and reinvest it in the business at a very high rate of return on equity again. So we call that a high rate of return on incremental capital or incremental equity. And typically over the long run, if you can find a business that can sustainably generate those high rates of return on incremental capital, you'll also identify a business whose share price does very, very well. In terms of prospects, we simply want a business that can grow. We want a business that's going to be bigger in the future than it is today. Warren Buffett once said, your job as an investor is to buy at a rational price a part interest of an easy to understand business whose earnings are virtually certain to be materially higher in 5, 10 or 15 years from now. So that's what I'm suggesting to you today, that we find a business that's high quality, that has high profitability, but also a business that's going to grow its profits. It's going to be able to sell more widgets, it's going to be able to sell more services, or it's going to be able to sell those at a higher price. Now, in order to be able to do those things sustainably over a long period of time, the business has to have a competitive advantage. The most valuable competitive advantage of all is the ability to charge more than last year for its product or service without a detrimental impact on its unit sales volume. So a business that can charge more without people turning away, without its customers turning away, that's the most valuable competitive advantage. And if a business can do that and demonstrate that it can do that year after year after year, then it has something that other companies can't replicate. It therefore is generally able to sustain a high rate of return on incremental capital, and its share price will look after itself. Now, after all of that, we also want to find a business that we think is rationally priced. We want to buy a business that's trading below its intrinsic value, or we want to buy a business whose intrinsic value is rising substantially year after year. Now, because intrinsic value is a point in time calculation, because it's saying we think the present value of the future earnings of this company are worth this today, in order for that intrinsic value to be higher next year and higher the year after that, then basically the company needs to exceed our expectations. So we're looking for businesses that are capable of exceeding our expectations. And if a company can do that, then its intrinsic value will rise and it will be re-rated by the market and its share price will go up. So if you can do these three things, you can find a business that has these three things, these three qualities, then you are doing very well to build a portfolio its share price will not only go up over time, but in market sell-offs, the likes of which we saw about this time last year, they will fall less than the rest of the market as well, and therefore preserve your capital. And that's the point I'm making over on the left-hand side of this screen. Okay, look, I've just summed up a 300 or 400 page book in the space of about 3 or 4 minutes. There is a lot more to it than that, obviously, but that's all we have time for today. If you want to find out more, then I'd be delighted for you to contact the hosts and pick up a copy of Valuable. Okay, how is the performance of this particular philosophy gone in the Australian market? Well, in the Australian market, it's done very, very well. As you can see here, the Montgomery Small Companies Fund has outperformed its peers and significantly outperformed the market. But perhaps more importantly, it's delivered those returns in a very palatable way. The green circle you can see on the chart in the upper left-hand side of this screen actually is the Montgomery Small Companies Fund since inception of the fund. And what it shows is that by drawing a horizontal line over to the vertical axis, it intersects at about 110%. What that means is that in any month where the market, the Australian market, the benchmark for this fund is the Australian Small Ordinaries Index. In any month where that index has risen, this portfolio, or the Small Companies Fund, has captured 110% of those gains. And you'll notice that if we draw a vertical line down to the horizontal axis, it intersects at about 80% or 79.6%. And what that means is that in any month where the market has fallen, the fund has only captured about 80% of the decline. So the fund is capturing 110% of the upside and only 80% of the downside. And you can imagine if the portfolio managers of this fund can continue to string together months and months and quarters and years and decades of this kind of performance, not only will they outperform the market, but we will also generate a return that is extremely palatable for our investors. So this is not a chart to sell the fund to you, and I'm not trying to do that. What I'm trying to do is demonstrate that the philosophy that I'm advocating in this session today actually works. So you can see over 1 month, 3 months, 12 months, and since inception, the performance of the fund has significantly outperformed the index. And I've put some of our winning and losing stocks in the recent quarter on the bottom on the left-hand side and over on the right-hand side. And we'll talk more about individual stocks as we talk about themes and companies a little bit later on in the session. The Poland Capital Growth Fund, the Global Growth Fund rather, you can see again, this fund's been running for about 6 years in the US. And you can see that it's also significantly outperformed its benchmark. And you can see that when you look at the alpha line on the bottom of the table at the bottom of this page. And you can see again, it's significantly outperformed over 1 year, 3 years, and 5 years. And it's done that with less volatility as well. Here's just another way of capturing the same data. Again, over 1 year, 3 years, and 5 years. Again, not to sell the fund to you, but more importantly, to demonstrate that there's merit in the philosophy that we're talking about today. Okay, so that's it in terms of the philosophy and performance. And what I now would like to do is ask the question and answer whether or not we're in a bubble. So the market has been infected by a bunch of different things over the last 12 months or thereabouts. We've obviously had the COVID-19 pandemic, and congrats, of course, to Australia and to Singapore, who've handled the pandemic extremely well. I can't speak for what life is like for you in Singapore, but in New South Wales, in Australia at least, it's pretty normal. We can't travel overseas, but life is pretty normal. People are having parties, we're going to the beach, we're going to restaurants, and it's all pretty normal. So, as long as we can keep infected travelers in quarantine and have them treated before they're released into the community, then we'll be able to handle the pandemic quite well. But that, of course, is not the Singapore experience and the Australian experience and the New Zealand experience is not the experience of the rest of the world. Europe is in its third wave. The United States has been arguably irresponsible under Trump in terms of the handling of COVID-19, and many, many hundreds of thousands of people have died. In addition to the pandemic, we've had central bank unconventional policy measures continuing and accelerating during the pandemic. And then, of course, on top of all of that, we've had some rampant speculation with the likes of the Reddit post that was run by Roaring Kitty and the others. And that what happened in the United States, my understanding is it can't happen in Singapore. It also can't happen in Australia, simply because in Australia, at least, if the share price moved up even a fraction of what the GameStop share price did in the United States, it would be shut down and an investigation would be underway before it would be allowed to trade again. So what the SEC allowed to happen in the United States would not be possible in Australia, and I'm pretty sure it wouldn't be possible in Singapore either. Nevertheless, it is a feature of markets over the last 12 months and something that has infected the psyche of many investors and many traders. So in terms of the question of whether or not markets are expensive, the answer to that is generally yes. If you look at the broad index, the market is indeed expensive. Have a look at this. This is the Cape-Shiller ratio, which is a cyclically adjusted price to earnings ratio. Robert Shiller invented this particular ratio, and he's back tested it, or rather he's reinvented it, if you like. It didn't exist in 1870, but he's gone back and filled in the blanks and recreated an index for that ratio going back to 1870. What you can see in this particular chart is that since 1870, there's only been one occasion where the market was more expensive on a PE basis than it is today. And that was in 1999, and I remember investing during 1999. I was working for Merrill Lynch at the time, and it was crazy times. The average first day premium for an IPO on the NASDAQ was about 90%. In other words, if you bought every float, on average, you'd make 90% in 1999. The market today is the second most expensive it's been since that time. And that's saying something, but it's not saying the market is at imminent risk of a crash. In fact, Robert Shiller said that his PE ratio, the Cape ratio, doesn't do a very good job of predicting crashes. However, it does an excellent job, a very good job, of predicting the average annual return for the subsequent decade. So the numbers that you can see on this particular chart describe the average annual return for the subsequent 10 years if you bought the S&P 500 at those points. And what you'll notice is that generally, when the PE ratio, when the Cape ratio is above 20, the returns are pretty low. When the ratio is below 15, the return is much better. And so there's been some work done on this, and I don't have the chart with me today, but what we know is that the implied future 10-year average annual return for the S&P 500 today, based on where the Cape ratio is low single-digit returns. So in other words, if you were going to buy the S&P 500 today, the index, remember, We're an active manager. We don't buy the index. We buy individual stocks, individual companies. But if you were to buy the index, you would expect a low single digit return based on today's levels. So the market, in other words, is expensive based on this particular ratio. What we also know is that so the market has been expensive, and that was one of the arguments that was put out by GMO and Jeremy Grantham earlier this year. He also said there is rampant speculative excess everywhere you turn, and he's absolutely right. In the United States, there have been so many companies like Nikola, Snowflake, Tesla, for example. There's been rampant speculation in those companies, and the share prices have gone to the stratosphere. If Tesla was priced on a PE basis compared to the earnings it makes from its cars, the PE ratio is infinite. And that's because it doesn't make a profit from selling cars. So Snowflake is another example of a company whose share price did very, very well after it listed. Its revenue just prior to listing was 265 million. It lost all of that money that year. It then lost another 349 million to record a loss of 349 million US dollars. The IPO price, the price that originally was going to list at, was 300% higher than the last funding round when it was in private equity hands 6 months before it listed. In other words, the supposed value of this company had grown 300% in just 6 months. And I can't think of a business in history where the intrinsic value of the business, the true value of a business, has risen by 300% in just 6 months. Nevertheless, the price that they could get this stock away at was 300% higher than the money they raised, or the valuation they raised money at just 6 months earlier. Now, the stock price actually went higher than that even before it listed, because I said to you that the IPO price was 300% higher, but that was at $75 to $85 a share. They then decided to raise the IPO price to between 100 and 110 US dollars per share, and demand was still extremely strong. So they raised the price again to $120 a share, which was 75 times the then current revenue run rate. And then upon listing, the share price nearly doubled. The company is currently trading at something like 130 times revenue, which is not uncommon, by the way, in today's market amongst some what we call profitless companies. GameStop, another company that obviously is an example of the kind of speculative excess that Jeremy Grantham was referring to. And typically in the past, the reason why Jeremy Grantham has made a big song and dance about the rampant speculative excess, and I note, forgetting about the stock market for a minute, those of you who understand NFTs or non-fungible tokens, you'll know that recently there was a work of art, a work of digital art that was sold by Christie's. It can't be seen in real life. It can only be seen online. And it's sold by Christie's for $69 million. And so, there's incredible things that happen when interest rates are at historic lows. When money is generating a punitive return, people go and do all sorts of silly things with their money because they're trying to generate a return that is otherwise unavailable elsewhere. GameStop was an example of that. Arguably, when it was trading back at $4, it probably was good value. The company was reducing its store footprint. The next generation of games consoles, which will probably be the last physical game consoles that will be brought out, but they were released with a DVD or a disc player in them. And that meant that GameStop could actually do very, very well in those circumstances. It's a store that sells video games. Short sellers didn't update their thesis. They didn't see that the company was reducing its overhead by reducing its store footprint. They didn't see that the new game consoles were going to have disc players in them. And so they hadn't updated their thesis, and they were caught short. In fact, they were caught short more than 100% of the stock that existed. And so it was an easy one for speculators to corner and then to force the short sellers to have to buy back their stock and push the share price up. And then we've got Tesla. Now, I wrote about Tesla some years ago, back in 2018, and I thought it was insane that the company's shares were trading at about $400,000 US per car sold at that time. Well, since 2018, the multiple per car sold has gone up even more. In fact, recently it traded at $1.4 million US per car sold. Compare that to the likes of Volkswagen, which was trading at about $9,000 US per car sold. GM about 8,000, Ford about 6,000 US per car sold. Toyota a little bit more than that. Mercedes-Benz trades at about $30,000 per car sold, and so does BMW. But Tesla is really in its own world at $1.4 million per car sold. And I question whether or not transforming, and everyone has an opinion on this, of course, everyone's allowed to have an opinion on it. I just wonder whether transforming the drivetrain transforms the economics of making a car for all of the manufacturers. Now, it's transformed the economics of making a car for Tesla. Tesla has the lowest cost for making batteries, for example, and they've got a great head start on the competition. But as we saw a few weeks ago, and you're welcome, if you've got a spare 2 hours, I recommend you look up Volkswagen Power Day webinar, a 2-hour global webinar where Volkswagen released its plans for electrification of cars, rolling out 17,000 fast charging stations in Europe, another 17,000 in China, and so on. So the question I've got is, yes, changing the drivetrain from an internal combustion engine to a BEV or a battery electric vehicle does change the economics of making a car. And that's a great advantage for Tesla, but only in the short term, because eventually these other companies are going to catch up. And in Volkswagen's Power Day, they announced a 25 billion euro capex program to compete head on with Tesla and potentially leapfrog them as well. They're going to be announcing a unified battery program, battery recycling. They're going to cut the cost of manufacturing batteries by about 50%. They're going to have more efficient batteries, which will mean they need less lithium, and so on. These will have implications upstream for lithium and cobalt manufacturers, and downstream as well for petrol stations or gas stations and the like. So I think Tesla is an example of speculative excess, and I think in years to come, we'll see that share price move down to better reflect the fact that it's another car manufacturer and not much more than that. In fact, the share price has already fallen about 30% from its recent highs. In Australia, we also have speculative excess in a sector of the market that we call the buy now, pay later space. So this is where consumers make a purchase at the store, but instead of actually paying for those goods, they take the goods home and they pay Afterpay for fortnightly installments, or if you like, over 8 weeks. They make 4 equal payments to pay that product off without any interest. And as long as they're not late, they don't have to pay anything extra. Now, how does this business model work? Well, Afterpay buys the receivables from the store, from the merchant. So let's say you're buying something from a store for $10. Afterpay will buy that receivable. You owe the store money. Afterpay will buy that receivable for, let's say, $9.90, and then collect the $10 from you that you owed the store. And that difference, that interest margin, that's what Afterpay makes. Now, because you're paying that off in 8 weeks, you can then, after you've paid that off, you can make another purchase and another purchase and another purchase. And so Afterpay's book turns over multiple times a year. Now, it only makes a 2 to 3% margin, closer to 2% margin on its business, on its book rather, but because it's turning it over multiple times, it can make a much higher return. And that's what investors got very excited about. But the market at one point pushed the valuation, the market valuation of this company up to $44 billion, despite the fact it didn't make any money. It doesn't make a profit. And in order to grow its book, it needs to borrow a lot of money, or it needs to raise fresh capital. It cannot grow its book without raising additional equity or debt. And at $44 billion at one point, it was 62% of our third biggest bank in Australia. We have a monopoly or an oligopoly banking structure in Australia. We have 4 major banks, and because of inertia, because it's such a hassle in Australia to change bank accounts, change all your PIN numbers, change all your cards, change your address, get approval, get all your ID together, the benefit of switching banks is not worth the hassle of changing banks. So there's a lot of inertia. So because of that inertia, banks get to make very, very high profits in Australia because of that monopoly scenario or oligopoly scenario. Even though Afterpay made no profit, at one point, it was trading at 62% of our third biggest bank. Now, to me, that is nothing short of insanity. I just think it's incredible. And at very close to the high point, the founders of the business sold quite a substantial amount of shares. So that's also telling. So again, examples of speculative excess. And here you can see it again. Peloton is a business based in the United States, doesn't make much money. What it does is it sells exercise bikes. They're fancy exercise bikes. They're connected to the internet. You can race your friends all around the world. You can do an exercise class, a spin class with your favorite instructor who could be based in another country. That's all really exciting, but it's just an exercise bike. And if you go to the local tip, if you go to a rubbish facility or a waste facility in Singapore or in Australia, you'll find lots of past fads, the exercise equipment from previous fads on those waste piles. And I wonder whether or not these exercise bikes will be found on waste piles in the future as well. It's a fad. Nevertheless, didn't stop the share price rising 657% in the course of a year, up until the end of about 2020. Tesla, you know all about Tesla, I'm sure. Share price up over 1,000% in the space of about a year. And since that time, of course, as I mentioned a moment ago, it's fallen about 30% or thereabouts. Okay, so we know the market's expensive. We know that there's a lot of examples of speculative excess in the market. Is that reason to expect a crash on its own? Well, we'll answer that question shortly, but before we do, what is important, I think, is interest rates. It is important to understand that interest rates have been declining for about 37 years. However, they have moved up at the long end of the yield curve, particularly in the United States and in Singapore as well. Your currency is pegged to the US dollar. In Australia, our yield curve has risen in sympathy with the US. So we've had 37 years of declining rates. When interest rates go down, the gravitational force on asset prices weakens. So when interest rates fall, asset prices go up. But when interest rates rise, asset values go down. And the way that works is through the present value formula. So if you look at the table on the bottom of this particular chart here, or this particular screenshot, you can see that back in April, on the 8th of April 2020, the US 10-year Treasury rate got down to 0.5%, so a half of 1%. Now, $1 earned in 1 year's time with a 0.5% discount rate is worth $1. But $1 earned in 5 years' time at 0.5% is only worth 98 cents today. $1 earned in 15 years' time is only worth 93 cents today at 0.5% interest rates. And $1 earned in 30 years' time is only worth 86 cents today if it could earn 0.5%. In other words, if I had 86 cents today and I invested it at 0.5% for 30 years, at the end of that 30 years, I would have $1. So this is the present value calculation. And businesses are worth the present value of all of their future income streams discounted back to today. Now, if interest rates rise, the present value declines. And the best way to demonstrate this is to go out 30 years. So at 0.5%, $1 in 30 years is only worth 86 cents today. But at 1.4%, which is how much the bond rate moved between the 8th of April and the 25th of February to 2021, at 1.4%, that dollar in 30 years' time, in today's terms, has declined to 66 cents. In other words, the present value has fallen almost 24%, or almost a quarter. So by virtue of the fact that bond rates have already risen a little bit, the present value of a dollar in the distant future has declined. And I would like to propose the idea that the reason Tesla's share price has fallen, we'll go back a slide here, the reason Peloton's share price has fallen, the reason Tesla's share price has fallen is these businesses are unprofitable. The hopes and dreams of investors in these companies is that one day in the distant future, they'll start earning a lot of money. But if that profit to be earned is in 30 years' time, then the present value of that dollar has just declined by almost a quarter, just from interest rates rising between the 8th of April last year and the 25th of February 21. And in fact, US Treasury rates are higher than 1.4% today. So that is a negative influence on share prices. And this is more important than the evidence of speculative bubbles. This is more, or speculative exuberance. This is more important than the CAPE ratio. This is what affects asset values, interest rates. So you have to keep a close eye on the yield curve. Okay, so in summary, we know markets are expensive. We know there's pockets of extreme behavior. We know that lots of IPOs are frequently doubling on their first day. We know that 30 to 40, even 100 times sales revenue is not uncommon at the moment at the very pointy end of technology and communications companies. And we know monetary policy is really easy. But I want to posit to you something else. I want to suggest to you that the leading companies in the United States, particularly that drive 25% of the performance of the S&P 500, are very, very powerful businesses. Remember right at the start, we talked about the philosophy. We talked about what makes a company great, what makes an extraordinary business. It has the ability to demonstrate a competitive advantage. And it's got, and the most powerful competitive advantage is the ability to raise prices without a detrimental impact on unit sales volume. Well, these four companies that you can see here, they make up almost 25%, sorry, 5 companies, they make up almost 25% of the S&P 500. And they have those competitive advantages. They've got awesome reputations. They've got maybe great geographical locations. They've got scale. They've got patents. They've got all the things that Warren Buffett said smart investors need to look for in identifying an extraordinary business. So while, yes, the S&P 500 looks expensive, 25% of that market, almost a quarter of that market, is really high quality technology businesses. Technology businesses aren't all created equal. And here it is. Remember earlier, right at the start of the presentation, I said, we want to find a business that can generate a high rate of return on equity and then reinvest a large proportion of those profits and generate a high rate of return on equity again. Imagine for a moment owning a bank account that had $1 million in it, earning 10%. And I said to you, well, Jeremiah, when your bank account gets to 10 million, you're going to earn 20%. And when your bank account gets to 50 million, you're going to earn 40%. And when your bank account gets to $1 billion, you're going to earn 50%. Now that would be a very, very valuable asset. That's an impossibly scarce asset. It's unrealistic, you would say. But look at the return on equity of Microsoft, Amazon, Alphabet, which owns Google. Look at the return on equity of these businesses. As they get bigger, as they retain more money in the equity of the balance sheet, they generate even higher returns. That's incredibly valuable. These are extremely powerful companies. And they've also got awesome growth ahead of them. Back in 1998, there are 150 million internet users. Today, there are 4.7 billion internet users and only 59% of the world's population, sorry, it is 49%, 49% of the world's population has access to the internet. So there's still many, many decades of growth to go. Now, today, there's more than 150 million internet users. There's actually a little bit fewer than that in Indonesia, but there's about 150 million in Brazil at the moment. So the growth for these companies will continue for many decades. And remember what I just said a moment ago, they're incredibly powerful. Now, of course, something could stop their growth. Government legislation, antitrust legislation could stop their growth. But at the moment, in the absence of antitrust legislation, these businesses are the sorts of businesses that Warren Buffett has been advocating for decades. So it should be no surprise that he owns Apple. Now, in terms of exuberance, the idea that there are pockets of exuberance, that there are bubbles in stocks like Tesla, really is not relevant. It doesn't mean the whole market's going to crash. Last year, we had a bubble in Hertz shares. They then fell about 85%. We had a bubble in Kodak shares. They then also fell about 85%. Nikola, which is hoping to manufacture a part or a device that can make trucks more efficient, large transport vehicles, it had a bubble and it fell 85%. And you might remember Bitcoin back in 2017, 2018. There was a bubble in that. There's arguably another one now. And its price fell by 85%. And the rest of the market was uninterrupted. Now, why was that? Why was it uninterrupted? It's very simple. These assets aren't held on the balance sheets of systemically important financial institutions. Think about that for a minute. Back in the GFC, or the global financial crisis, the great financial crisis, the reason why we had Armageddon in the stock market is because there was a financial crisis. And the reason why there was a financial crisis is because the assets that collapsed, they were on the balance sheets of systemically important financial institutions. But Bitcoin isn't, Nikola isn't, Kodak isn't, Tesla isn't. So because these share prices are not held by the banks that are important to the global financial system, then they can inflate into a bubble and collapse, and it doesn't matter. The rest of the market just goes on. Now, it is true that that period of excess or exuberance will end one day, and it will end when the stock market comes off. But the stock market isn't going to crash because there are bubbles in these stocks. And that's the point that I want to leave you with. The bubbles can inflate and deflate, and that's absolutely fine. It can happen in isolation. You can't infer from that the whole market is a bubble and the whole market is at imminent risk of collapse. It's also the point that after very, very steep recessions, in aggregate, over time, on average, the market has done very well for a few years after that recession. That red line represents the median of the stock market's performance after all, on average, if you like, the median, after all post-war recessions combined. This particular chart, I think, is quite valuable. It's one that lots of fund managers keep an eye on. The purple or the blue line that you can see there represents the earnings yield of the S&P 500. Now, the earnings yield is just the inverse of the price to earnings ratio. In other words, if the price to earnings ratio is 20, then the earnings yield is 5%. That's all it is. The gray line is the US 10-year bond market's yield. So the yield on a US 10-year treasury. Now, because there's more risk in the stock market, over history, you would expect that the earnings yield of the stock markets, of the S&P 500, should be higher than the bond yield of the US Treasury. And so over time, you see this play out. You can see that the purple line is more often than not higher than the US Treasury yield, the 10-year bond yield. But there are times where it inverts, where so much enthusiasm exists for the stock market and prices are pushed so high that the earnings yield falls below the bond yield of the US Treasury market for 10 years. And so when that happens, on the two occasions on this chart where that has actually occurred, that was in 1929, example A, and in 1999, example B. And you can see at the moment, the earnings yield of the S&P 500 is a long way away from the 10-year Treasury bond rate. And that is a suggestion that we're not going to see the type of bubble burst that produces a depression or a very, very steep recession. It doesn't appear to be the case that there's so much enthusiasm for the stock market broadly that yields are ridiculously low. So that's another reason to say that I don't think we're in a bubble for the entire market. There are examples of bubbles, there are sectors of the market in bubbles, but from that you can't infer the whole market is a bubble. And this chart tells you likewise, you can't infer that the market is in a bubble. And looking at the Straits Times Index, if we look at the Singapore 10-year bond yield, which on Friday closed at 1.59%, if we add what is a reasonable equity risk premium over the last 100 years, it's averaged about 4%. We add those things together, the equity risk premium gives us the additional return that we want to justify investing in the stock market. Combining that with the 10-year bond yield gives us an earnings yield equivalent, a stock market earnings yield equivalent for fair value of about 5.6% or thereabouts. We divide that into 100, we get a PE ratio, because that's the inverse. We get 17.9 times. So the Straits Times Index, the STI, is on a PE at the moment of about 21 times forward earnings, 1 year forward earnings. So it's at a 14% premium over what would arguably be fair value. So again, it's a little bit expensive, but so is the S&P 500, so is the Australian market. It's a little bit expensive, but that doesn't mean that it's at imminent risk of a crash. And remember, we're not buying the index. If we're not buying the index, we're buying individual companies. There are plenty of companies that represent good value out there. Now, I want to talk a little bit about inflation, because it's really, I think this is a really, really useful framework that was developed by Gavicle Research back in 1978. And it's worked really, really well since then. Since 1978 to today, if you'd used this framework, it would have produced really, really, it would have produced superior results for you. In fact, some more recent Gavicle research found that going back 143 years for the S&P 500, if you only invested in the S&P 500 during disinflationary periods, in other words, when inflation was declining, you got the same return as being invested in the stock market the entire time. In other words, you would have been out of the stock market half the time, reduced your risk massively because you weren't in the stock market, you weren't invested in the stock market during those times, and you ended up with the same return. So that's really interesting research. This research here is a little bit different. It's just trying to define the economy by two critical factors, economic growth and inflation. So down the bottom, we have disinflation. In other words, declining inflation or declining price growth, declining rates of price growth in the economy. Over on the left-hand side, we have, you can see here, on the left-hand side, we have busts, economic busts. So growth is on the horizontal axis. So we have economic busts, so declining GDP. Over on the right-hand side, we have growing economies, so rising growth rates or rising GDP. So when you have a disinflationary boom, but bottom right-hand side, this is a period we've just been in. We've had declining inflation and booming economies or growing economies. That is great time for equity investors, particularly growth investors. Now, in 1978, Gavicle said disinflationary booms were great for innovative companies with pricing power. So today, what's an innovative company with pricing power? Apple, Google, Amazon. You know, they're the sort of companies that Buffett's been talking about. They do really well in a disinflationary boom. In an inflationary boom, value stocks do well, commodities do well, emerging markets do well, okay? And that's consistent today with what was described in 1978. An inflationary bust, well, that's pretty much bad for everything. You want to be out of everything, except for cash in the safest currencies. What are the safest currencies? Well, they're typically countries with current account surpluses or large fiscal surpluses. Can I just throw this in? I would think that an inflationary bust is the perfect environment for cryptocurrencies. If we get a rising inflation and a bust in the economy, it's going to be a disaster for everything, but maybe not gold and maybe not cryptocurrencies. So keep an eye on some of those second and third tier currencies, those project-based currencies. Some of you might be into farming and staking and all of that. You know, that environment, an inflationary bust, could be a whole new world for popularity of those strategies and for cryptocurrencies as well. And then on the bottom left-hand side, the disinflationary bust, that's where we've got prices declining and an economic bust. And really, the best thing to be in there is probably government bonds and nothing else. So it tends to be bad times for commodities as well. Okay, I'm going to leave that with you. You can take screenshots of that, or there's a recording of the presentation, and you're able to keep that somewhere where you trade, where you invest, and just remember that framework in the back of your mind and ask yourself, where do I think we are and where do I think we're going? Okay, so Trump lost the election. That's probably a good thing for democracy around the world. The consequences obviously are also very good for fiscal policy because he was a populist. He didn't spend a lot of money, didn't want to spend a lot of money, and consequently, that's going to be good for infrastructure spending in the United States now. The vaccine is rolling out. I know there's going to be fits and starts. It's going to be lumpy. It's going to be disrupted. There's going to be setbacks, but the end has begun. The end of COVID and that pandemic, the end of the pandemic has begun through the rollout of these vaccines. There'll probably be 7 different strains of the virus. Some of them will be nothing to worry about. Some of them will be much, much worse. But I think we've now got the technology to be able to respond and develop vaccines. So the end of COVID, the end of the pandemic has definitely begun. That's a great thing. Short-term fiscal support still going to be necessary. We know that. The economies are going okay in many Western liberal democracies, but they're going okay because of fiscal support, because of very large fiscal deficits. So that's going to continue for a while. And because there's very little inflation about, governments are going to be very, very happy to continue providing support and borrowing more money to do it. And central banks equally are going to be very happy to continue to adopt unconventional monetary policy or quantitative easing policies. Now, in terms of inflation at the very bottom, I think there's going to be a burst of inflation coming, but I think it's going to be temporary. And I say there's going to be a burst because as we come out of COVID-related lockdowns around the world, people are going to celebrate, they're going to spend money, the government's given them a lot of money to spend, and we'll see that reflected in prices. But wages are not growing substantially. That's the first thing. You can't have 3% inflation without 3% in salary growth around the world. And also, I would say that technology has permanently shifted the inflation curve. The ability to sell a product without a marginal cost, at no marginal cost to a company, that really permanently shifts the cost of supplying those goods. That means that I think we're in a world of low inflation for many, many decades, maybe a decade at least. I can't predict beyond that. And I think while we might have a burst of inflation in the short term that the market's going to get scared about, I think that'll be a buying opportunity, if anything, because I think in low inflation is probably structural. Okay, in terms of themes and companies, very quickly, and we'll speed through these because I'm running out of time. Forgive me for that. I've had a lot to say. I think generally the market is expensive, as we talked about. Most companies are probably expensive, but that doesn't mean there's not a subset of companies that are significantly undervalued, and there are some companies that are undervalued. So there's undervalued companies, but there's some significantly undervalued companies. Those companies that are going to grow much faster than the market currently expects, they're significantly undervalued. If the market has valued those businesses based on, let's say, 5 years of growth at 20%, but the company can grow at 25% for 5 years, or it can grow at 20% for 10 years, then the market is understating its growth potential. That company will be re-rated. That is where we like to say there's value under your nose. It's there for you. You just have to identify the companies that are going to grow faster than what the market currently thinks, or grow at the current rates for longer. Okay, now we think there are a number of things. I've put some Australian companies up here to begin with, companies that I'm familiar with or very familiar with. And so some of the themes are cloud computing, for example. Now, cloud computing companies in Australia and around the world have sold off recently because, number one, some of their profits are long dated, they're long duration stocks. And there's also the belief that these cloud companies or these data centers, for example, they benefited from, they got a shot in the arm, if you like, from the COVID lockdowns. People were streaming movies and music a lot more. They were shopping online a lot more. And so demands on cloud computing, demands on data centers spiked. But this is a structural trend. This is not something that's short term. More and more enterprise computing will be moved to the cloud. At the moment, penetration is only about 22%. That's where laptops were 20 years ago. That's where smartphones were 10 years ago. And so, you know, cloud computing at an enterprise level is going to be a big part, a big revenue generator for another decade or two. It's not a flash in the pan related to COVID. So the share prices have come off, which is a great opportunity. I've listed a few companies there for you that are based in Australia. You can go and investigate Macquarie Telecom, for example, Megaport, NextDC is another one. Big Tin Can is not and City Chic are not data center companies. City Chic is an online clothing company. Big Tin Can, IT-based technology company, but powered by the cloud. And that's the other thing. Cloud computing is democratizing computing power. It's taking what was once a competitive advantage for large companies that could afford computing very powerful computers in their buildings, in their facilities, and it said, you know what, you're a small company, you can't afford that, but don't worry, all of that exists in the cloud and you can compete on a level playing field. So that's one thing we think is really powerful. Another one is on the right-hand side, the vaccines. This is what we call the reopening trade. These are companies that are going to benefit as the economies reopen. You know, in Australia, they're travel agents, for example. They're international student pathway companies like IDP Education. They're providing university pathways into Australia. So foreign students can sit an exam, do an English language test, and then attend university in Australian university. Now, of course, our borders are closed at the moment. But eventually, through the vaccine, those borders will open. These companies will make a ton of money again. Overseas, some of the travel stocks, for example, the cruise lines maybe, you know, they're a bit more speculative, but, you know, the likes of Carnival Cruises, you know, I own shares in that company. That's a business that has raised a huge amount of debt to survive the lockdown. And yes, some of those ships are going to be mothballed and be destroyed, but people will continue to go on cruises as soon as they can. Now, I know one cruise line that sent an email out to its customers whose cruises were cancelled. By the way, 80% of international cruise passengers come from the United States. So one of these cruise lines sent out an email and said, look, your cruise has been cancelled. We're really sorry. We can give you a 100% money back offer, or we'll keep your money and we'll give you a $200 credit on board to spend on board at some future date when you cruise with us again. Which deal do you want? Do you want your money back or do you want the $200 credit? Almost 99% of passengers are reported to have taken the $200 voucher. That's how passionate people who cruise are. They can't wait to cruise again. So there's some opportunities on the vaccine side. Then, of course, we've got government stimulus over on the bottom right-hand side. This is true for Australia. It's also true around the world. Companies are going to benefit by spending, by government spending to stimulate the economy, to spend money on infrastructure, to spend money on green energy, for example. And though we want to invest in companies that are going to benefit from that. Orocobra, lithium, and you know, it's rare earth type businesses. We think those businesses are going to do very well because once COVID is over, we'll all have the luxury again of demanding cleaner energy and electric vehicles, and they're going to be huge themes after the pandemic is gone and forgotten. Over on the left-hand side, income. Income's really important with interest rates so low. Pension funds around the world, the big pension funds like the Canadian Teachers Pension Fund or Temasek, the sovereign funds in Singapore, they're looking for income. They're looking to take over businesses and buy businesses that generate boring annuity style income streams. So look for those sorts of businesses as well. I've listed a few Australian ones there. This is a business called Unity Wireless, listed in Australia, run by two people that we believe have got already a phenomenal reputation in the telecommunications space. They will end up owning the second biggest broadband network in the Western Sydney region. Now, it is a micro cap company. It's a very, very small company, but it's an example of the sort of business that even in a COVID environment is growing phenomenally. Okay, turning globally now. Our Poland Capital Global Growth Fund. Poland Capital own a whole bunch of technology companies, but not all technology companies are the same. So it's really important. You don't see Tesla here, but you do see Microsoft. You do see PayPal. Autodesk. Autodesk produces software for architects, for industrial designers. You've probably heard of CAD. They make that software. You can see Tencent and Alibaba there, which is exposed to the Chinese consumer. You can see digital advertising in Google and Facebook as well. And so remember, we're looking for high quality businesses that generate high rates of return on incremental capital. And they've got a long runway for growth available to them. Poland Capital is looking for businesses that can grow at least double digits for the next 5 years. So within that 5-year period, the belief by Poland is that these companies are going to be able to grow at double-digit rates. You can see here on the left-hand side, you can see these companies that I've just listed. These companies are growing their long-term earnings per share. They're expected to grow at double-digit rates from over 10% up to 25% per annum for the next 5 years or thereabouts. But you'll also notice that even though they're growing faster than the S&P 500 average and the all-country world index and the Morgan Stanley index, you can see that, the technology index and the all-country world index, you can see that some of it, there's a variety of PE ratios. Some of them are around 20, some of them are much higher. But remember, PEs on their own don't tell you anything about value. PE doesn't tell you a thing about whether a company is intrinsically cheap or intrinsically expensive. And the other point to make is when you look at, let's say, Facebook, for example, compared to the S&P 500 and Google compared to the S&P 500, you can actually see that their PE ratios are getting very close to the broader index. So they're not particularly expensive compared to the broader index in some examples. But it's important to note, if you've got a company on a higher PE, it could be cheap, provided it's growing at a fast rate. And looking more broadly at other companies held by the Poland Capital Global Growth Fund, you can see outside of technology, there's a bunch of companies that Poland believes, and we believe, and we agree with them. There's a whole bunch of companies here able to grow at very attractive rates over the next 2, 3, 4, and 5 years, despite the fact that overall the market is expensive, despite the fact that overall the yield curve might be steepening slightly, despite the fact that there's pockets of irrational exuberance in the market at the moment. So another growth theme that we think is really interesting is electric vehicles. We think this is the tipping point's been reached. We know that jurisdictions like California have, and many other countries around the world, have mandated that zero emission cars are the only cars to be sold by 2030 or 2035 or 2040. So 2030, remember, is only 9 years away. It's not very far away at all. And so California, the US is the biggest passenger car market in the world. California is the biggest market within the United States. California has said all cars sold and light trucks sold in California in 2030 must be zero emission. So manufacturers around the world are going to be retooling. They're not going to be selling internal combustion engines in one market and electric vehicles in another market if they can help it. And so this is happening. So demand for the raw materials that go into those batteries. And by the way, those batteries will get more efficient. They'll be more efficient today. So the demand for lithium, the demand for cobalt and the other ingredients, what goes into the cathode and the anode of a battery, the raw materials, less of that stuff will be required as batteries become more efficient. But overall, there's still going to be huge demand. And so we think there's a great story amongst the upstream suppliers of some of these commodities as well. Okay, so looking at some Australian small caps, companies that we think have a great opportunity at the moment. Remember what I said when I gave the disclaimer right at the start of the presentation. You might remember I mentioned our thesis could change on any one of these companies tomorrow. I'm not going to be able to give you an update because I'm not giving a webinar tomorrow. So just do your own due diligence, do your own research, seek and take personal professional advice. Okay, another company that we really like, that we think's got long-term growth ahead of it, is a company called Codan. What does it do? It sells metal detectors and gold detectors. You wouldn't have thought that'd be a great business, but it's a business that's done a phenomenal job of expanding the market for metal detectors and gold detectors. In fact, what it's done recently, it's recently introduced a new detector that's great for people who want to just scour the beach looking for money that's been left behind or jewelry that's been left behind. And whether you agree with that morally or not, that's up to you, but people do buy these things. And what's interesting is the more they sell of these metal detectors that aren't gold detectors, the less reliant this business is on the gold price. The more excited analysts get about being able to forecast this company's earnings, and so they put a higher PE on it because the earnings are more reliable. So that transformation from a company that was really dependent on the gold price to a company that can produce reliable income, annuity style income, that then sees the PE expand. When the PE expands, share price goes up. Okay, so what are the takeouts from today's session, our final session from this weekend? I can't imagine how difficult it is to set up something like this, but well done, guys, for doing that. The final slide is this. The market is a little expensive, but it's being driven by high-quality companies. There are pockets of exuberance, but they can inflate and deflate like Tesla. Tesla's off 30% since its highs without disrupting the rest of the market. The market is not extremely stretched when you compare it to bonds. It's about 10% to 15% overvalued compared to bonds. And if those yields keep rising though, if the market doesn't go down, then the market is more expensive. So you've got to keep that in mind. And by the way, irrespective of what the S&P 500 is doing, or the Straits Times Index is doing, or the All Ordinaries Index in Australia, there are themes within that and companies within the market with long runways for growth and at reasonable valuations. So I'm going to finish up there. I really appreciate your time, guys. You've got enormous endurance. I've only had to give a 1 hour talk or 1 hour, 10-minute talk. You've been listening to talks all day. So congratulations and well done. I'm really impressed. I'm going to open up to Q&A now. Look forward to answering some of your questions.
All right, thank you, Roger, for your sharing. I get a lot of insights from your macro views, some of the themes that you're looking at, and some of the certain stocks that you shared in your presentation. Let me take a look at the Q&A. Let's see. All right, so one very interesting question is that by Howard is that, do you foresee that cargo ship in Suez Canal causing panic in the stock market?
I don't think so, because the market is already very aware of it. Yep. In order for panic to come, it's usually what we call a black swan. It's an event that the market wasn't anticipating. And while the market's didn't anticipate this particular event, I think it's taken it in its stride.
All right. So you mentioned that the market is a little bit expensive, but not in an exuberance mode, right? But Wave Rider is asking, will you short those bubble stock like Tesla or buy long-term put options knowing that they are so expensive?
I think it's very dangerous to short sell a bubble because the market can keep going up for a long time. Short selling is extremely difficult. I know a lot of fund managers who've lost a lot of money trying to short sell. The thesis was right, the valuation was right, and yet the share price kept going up. So you have to be, there will come a time, obviously, when the market crashes, short sellers will make hay. They'll do really, really well. But it's, you know, I would rather look for great companies. I think it's easier to find great companies that are going to grow than to try and short sell companies, hoping that sentiment towards those companies changes. Because that's really what you're doing. You're betting on the sentiment shifting. And that's a really hard thing. Unless you know there's a catalyst that's going to trigger a change in sentiment and sentiment's going to turn bearish, it's really hard to short sell.
All right. So I think that answers a question, Howard. And Howard also asking about this tech stock. So recently the US market has been coming down
Yes.
due to the tech rotation. I think he's asking whether when the investor will start rotating back to the big tech and other tech stocks. Do you have an opinion on that?
I don't know the date. I'd like to be able to say to you it's going to be May the 7th at 3 p.m. You know, but I don't have a crystal ball, so I can't tell you that. But what I do know is that if you're correctly valuing a company and you're estimating its growth conservatively, when it turns up cheap, you know, the idea is our philosophy is you buy it. And if the share price falls further, unless the thesis has changed, you buy more. And in the long run, you'll do extremely well just doing that time and time again.
All right. So Chiu is asking, what do you think of the views of funds moving into cryptocurrencies due to the constant tremendous amount of money printing, QE, and is the effect of the 10-year bond yield on the stock market the same as the effect of increase in interest rate? And do you foresee an increase in interest rate this year?
Okay, so there's quite a bit.
Yeah, maybe you can just talk about the
Let's talk about
cryptocurrencies
cryptos first. Yeah. So I want to be really clear about this. I don't think the thesis for a lot of people investing in cryptos is right. So I don't think we're going to see a universal cryptocurrency that replaces fiat money. But that doesn't mean there's not a lot of money to be made in cryptos. It's just that it's got nothing to do with cryptos replacing fiat money. The thesis is about the individual currencies that support things like NFTs. So depending on which blockchain, you know, the Ethereum blockchain, for example, which is the blockchain that's used for NFTs, you know, the cryptos on that, if NFTs gain popularity, more currencies are going to be needed for that particular blockchain to support that blockchain and to support that endeavor. That will be positive for that particular crypto. It's like large caps, you know, your large caps, Bitcoin and Ethereum. Then you got your small caps and your micro caps. And so there'll be individual stories that support popularity of individual cryptos. And I think that's right. I think there's an opportunity there. So in answer to the question, you know, I think some of these funds are going to do very well. You know, there's a fund in Australia that specializes in crypto investing. I think last year it made 176% or something. You know, it did astounding returns. But it is appropriate to invest only a small speculative part of your portfolio to it. You know, now Goldman Sachs, I think, have recently conceded, was it Goldman's? I think it was Goldman's. They recently said, okay, look, if people want to invest in cryptos, okay, but it shouldn't be more than 5% of a portfolio.
All right. So since you are on the crypto topic, you mentioned about the NFT, the non-fungible token. Recently, it has been a craze. You know, there's one Singaporean spending $69 million on an artwork, and there are a lot of other, you know, NFTs selling for millions of dollars, tweets, or whatever. So do you think this is just a fad or a bubble, or is it here to stay in the near future?
I think it's here to. I think NFTs are here to stay. But whether or not in the future people pay the sorts of prices for an NFT that they're paying today, that I'm not sure about. They could pay a lot more. If interest rates go up, I promise you, if interest rates on a term deposit on a bank account were 10%, there'd be a lot less speculation in these kinds of activities, a lot less. That's because people would say, you know what, I can get a safe 10%. I don't need to risk my capital. I'm happy with that. And so a lot of money would migrate from these speculative endeavors back to bank accounts. So I said earlier, interest rates act like gravity on asset prices, right? And I gave that slide in that table displaying how that works. That's true. If interest rates keep going up, more money is going to move away from these speculative endeavors. So, but I don't think it kills NFTs. NFTs could be around for a long, long time. And I think there's a future for them, but I don't know at what price.
All right. So back to the question, do you foresee an increase in the interest rate this year?
Well, they're already going up. I don't think central banks will raise short-term rates, but bond rates are already rising. So the yield curve is already steepening. If you just Google US yield curve or Singapore yield curve or Aussie yield curve, you can see it used to be flat and now it's got a positive slope to it. So it's steepening. That's negative for growth stocks. That's why we've seen growth stocks come off.
All right. So Yap is asking, what is the cash holding that you recommend given the current equity climate? I believe he's asking about the, your portfolio, how much should be in cash right now?
I think the right amount of cash in the long run is zero. For young people, for the sort of people that are watching today, for everybody watching today, you're young, you've got a long life ahead of you, you can stomach a few setbacks in the stock market. If the stock market falls 30%, you're still earning an income you can add to your portfolio. You've got 30, 40, 50 years of growth ahead of you. That's a great thing. You want to take advantage of sell-offs. So cash doesn't produce a great return. So you want to be in high quality businesses. I said a moment ago that rising interest rates are not good for growth companies. I'm talking specifically about unprofitable growth companies. Profitable growth companies will do very, very well, particularly if they're growing at double-digit rates.
All right, thank you for your answer. And Kenny is asking about this. What is the outlook for semiconductors? Do you have any views on that?
I mean, it really depends. Maybe it's got something to do with this boat blocking trade for 10% of the world. In the short run, there's a shortage. We've got a shortage and there's going to be huge demand for it. So, that's another, remember I talked about upstream suppliers, there's a good story, there's a good thematic there, but you got to dig down to find the good companies and then the appropriately priced ones. Hey, I noticed that there's quite a few people who are putting comments on the chat.
Yes.
And wanting me to answer on the chat, but can I just tell everyone it's easier for us to answer if you put your question up in the Q&A section. But I did notice there's quite a few people putting comments on the chat.
Yeah, but they are not really asking
a
lot of questions on the chat. Mostly are putting it in the Q&A. So yeah, so let's continue. So we have some time. So Victor is asking, what are your thoughts on these cyclicals, these consumer discretionary sectors, cyclicals?
Yeah, look, there are cyclicals and there are cyclicals, right? So you've got your materials suppliers, you've got your iron ore manufacturers, they're considered a cyclical. You've got some financials, for example, the banks are considered cyclical as well. And then you've got consumer discretionary. I think there are some consumer discretionary stocks that are going to go bust, that are going to fall into bankruptcy. And it's going to happen more over the next 12 months, even more than we saw in the last 12 months. But there are also individual consumer discretionary stocks that are going to do extremely well. They're going to take market share from those companies that go bust. It's important to discern the difference. So it's very hard for me to give you a view on discretionary consumer stocks or discretionary retail stocks in aggregate, because every company is a little bit different.
All right. So back to Howard again. So he asked, do you trim your holdings during the first quarter in 2020, or do you hold most of your holdings throughout? And how do you manage your investment portfolio?
In our Australian
up and down?
In our Australian small companies portfolio, in February, around mid-February 2020, we moved to about 40% cash. And in our broad cap fund, we moved to about 30% cash. So that was just as the sell-off was starting. And the reason why we did that is we were tracking testing rates. So all around the world, fund managers were tracking death rates and infection rates. But you might remember in February, the US was saying, Donald Trump was saying, there's nothing to see here. It's one Chinese guy and we've got him, you know, and then it's after Trump said it's fake news. So we knew that the problem was not that there were no infections in the United States, there was no testing. And in fact, when we collated all the data from the CDC and the private pathology labs, what we found is that in January, remember the US has a population of 330 or 340 million people. In the US, the total number of COVID tests being carried out per day averaged 42. 42 tests a day. And then in February, they ramped it up to 90 tests a day out of 330 or 340 million people. So we knew that the US was going to get a terrible shock, a rude awakening they were going to experience. Because once they ramped up testing, they would find they'd let the infection spread. They'd let it go too long. And in fact, that's what happened. In New York, when they started testing, 50% infection rates. So ahead of that, we decided to move a very large proportion of our portfolio to cash. But the Poland guys, based in Boca Raton in New York and London, they stay fully invested, but in very high quality growth companies. And while the portfolio declined, it didn't decline anywhere near as much as the market. So they produced lower volatility by sticking to very high quality growth companies.
All right, thank you for your answer. And there are a few questions asking about gold. Generally, I think the question is, do you think cryptocurrencies has really taken away as a store of value?
Not for everyone. For some people, yes, but not for everyone. You can't really do anything with gold. Warren Buffett once said many years ago, he said, I don't understand gold. All you can do is look at it and fondle it. You can touch it and you can look at it, but it doesn't do anything. And if you melted all the gold together and made a cube out of it, it would sit inside all the gold that was ever produced in the world. It would sit inside a baseball infield, about 68 yards high, 68 yards wide, and 68 yards deep. And in 100 years' time, it would still be there. And it hasn't done anything. So gold is a bet. Gold is a bet on other people's fear. And if we get an inflationary bust, then I think Bitcoin, I think the cryptos, there will be more people putting money into those things as a bet on the fear. Whether or not, forget about whether it's going to be a fiat, it can replace fiat currency and all of that sort of stuff. I don't think that's the right thesis. I don't think that's the right argument. But I think the popularity of it would increase enormously in that scenario. And so would gold. Gold will go up as well.
Recently, gold prices has been coming down.
Yes.
Yep.
Because people aren't concerned. People are less worried about, there's less fear. If there's less fear, gold price comes down, right? It's a bet on other people's fear.
Let me see some of the questions. Right, quite a few on the gold. Let's see. Oh, your opinion on oil. How about oil in the short to mid-term? Your opinion on oil?
Yeah, it was really easy when it went negative to buy oil. I personally bought oil. I bought oil futures. I bought oil ETFs. Friends of mine here in Australia who live just around the corner, they called me. They said, Roger, oil's gone negative. What should you do? And I said, empty your swimming pool and fill it with petrol. Because, it's not going to stay here forever. It's unsustainable at a negative price. That's ridiculous. So it was really easy. Even my son, he came downstairs and he's only 19 years of age. And he said, Dad, what do you think I should do? I said, buy oil ETFs. He's done really well out of it. He's been really grateful for that. But at current levels, it's back to being noisy again. It's not so easy to know where oil's going to go. On the positive slide, you could have interruptions to supply, such as what we're seeing. On the negative side, you're going to see an entire world fleet of vehicles switch from burning oil to running batteries. So demand is going to decline. There's a famous saying famous phrase from in the 1970s from a Saudi Arabian oil minister and he said, what was the phrase exactly? I don't want to paraphrase. I want to get it right. He said, the Stone Age did not end for a lack of stones. New technology replaced it. We left the stones in the ground. We had the Bronze Age. And what he was saying, what he was implying is one day we will leave oil in the ground. New technology will replace it. And so, that's a negative story for oil. So it's really hard at $70 a barrel. It's really hard to know exactly which way it's going to go next. When it was negative, if we'd done this webinar when oil prices were negative, I would have said, guys, it is impossible for oil to stay negative. Absolutely impossible. So now's the time to be thinking about buying oil. I'm sorry I can't give you a clearer answer now.
All right, no issue on that. And okay, I think we are running short of time. We will take the last question, and Adeline is asking, what is your take on the Chinese market and the stocks? The Chinese market in general.
I prefer, generally speaking, I prefer markets where I can trust the information that's being provided. And I don't always get that with Chinese companies. So in
short, you're referring that you don't trust Chinese companies' annual report. Is that right?
Not all of them. Not all of them. I think where they're larger companies, where there's a lot of analytical work being put into dissecting that particular company, or the Alibabas of the world, the Tencents of the world, I think they're a safer bet. But remember, the government can change the rules at a moment's notice. They're moving in an antitrust direction right now. The narrative is changing in China anyway. So some of these big companies, their growth prospects might not be as good as they once were.
Yeah, I understand. So thank you for sharing and answering all these questions. Jeremiah, are you here?
Yep. All right. So I guess thank you so much for the engaging session. Alex, for moderating the Q&A segment, and Roger, thank you so much for your insights. I want to thank you for, obviously, it's probably close to bedtime now, right, Roger?
Not quite bedtime, but I definitely like to rejoin my family.
Now it's 8:30 Sydney time,
PM.
right?
Yeah.
Yes.
30, yeah. So
in
probably
Singapore, you guys be just going out for dinner now, right?
Yep.
That's right. So
good for you. I wish I was there.
Well, we're gonna get our dinner, and you're probably gonna get your start your glasses of wine at this point. But either way, we're gonna go for some refreshments. And at this point, I would like to thank every single one of you for taking the time out, being here with us yesterday for the entire day, as well as today for the entire day from 10 a.m. all the way until 5:30, which is right now. As Roger and Alex have mentioned, right now is the time to go and enjoy time with your family, have some dinner, grab some wine, whatever it is. I want to thank all of you once again. And at this point as well, I just want to do a quick shout out for the upcoming event happening in July. I'm just going to quickly share my screen at this point. We do have our upcoming Market Insights virtual summit that's happening in July on the 10th and on the 11th. We have invited some incredible guest speakers, Tom Basso, who is the founder of Trendstat Capital Management, as well as Michael Covell, who is the founder of trendfollowing.com. We will be talking about the trend following mindset in that session. So please, I would highly encourage you to join, to use the link at the top, or Alex would have sent the link in the Zoom chat to just click on that and reserve your spot for the upcoming session. And that's all I wanted to share. If not, thank you so much. I hope it has been an engaging 2 days of different sessions. If you do have any questions, a reminder on things like the recordings that will be sent to you tomorrow, right, Alex?
Yes, I will send the recordings to you by tomorrow morning.
All right, perfect. So with that, if you also have any other questions about upcoming events, you can also click to join our Telegram and Facebook group as well. Alex, if you don't mind, help me just to send that 2 links in the chat before we call it a day. Those channels will have all the information you need for any upcoming items. But if not, thank you so much from the guys over here at MarketWise. Enjoy the rest of your day, and we'll see you for the next event.
And thank you, Roger, for sharing. Appreciate that.
Well done. And I really appreciate all the well wishes from everyone. Thank you very much.
Okay, thank you. we'll call it a day and we'll end the session right now. See you guys again in July. All right.
Guys,
Bye-bye.
thank you and goodbye.